I'm Nicholas Bornos of Capital Link, and I would like to welcome you to this particular session. Our forum is called London Calling Super Cycle Ahead for Shipping. So here we're going to have a panel that will provide the investor viewpoint on shipping, and then we will conclude with the panel from the ship owner perspective in terms of do we have a super cycle. So without any more delay, I will turn it over to Joachim Rasmussen from Fearnley Securities. I would like to thank all the panelists. I'll let Joachim introduce the panelists, and I'd like to remind everybody that we are hosting today's forum in partnership with Fearnley's, Fearnley. So Joachim, double thanks to you. And thank you to everybody. And the floor is yours.
Okay, thank you, Nicholas. Just to tell everyone who we have on, we have Mr. Andrian, Dacy, the CEO of a managing director of Global Transportation Group at JP Morgan. We have Simon Roxon Johansson, who's the Global Portfolio Manager at KLP. We have Roberto Rondelli, who's the Managing Director at Pillarstone. And then we have Will Homan Russell, who's the Managing Director and Portfolio at WMC Capital. I think for the audience, for everyone to get a bit acquainted to each or every, it would be great if we could just do the round, maybe starting with you, Will, where you give a few words about yourself, the fund, the strategy, etc. And just keep it short and simple, and we can do the round, and we can dive into the world of shipping.
Okay, thanks, Joachim. Thanks for inviting me here. Will Homan Russell. I'm the Chief Investment Officer of WMC Capital, and our main fund we're running there is the Albemarle Shipping Fund, which is a hedge fund investing in global shipping on a long-short basis, predominantly equities, but also looking at commodities, FFAs, investing from a kind of fundamental value basis, investing in various companies, strategies, sectors against themselves over the cycle of shipping. We were set up in the end of 2018 when we started to see the supply side really coming to fruition, and have recently converted what was a UK LLP into a traditional fund structure just this month, and gone live this month.
Thank you, Will. Roberto?
Thank you. Hi, everybody. I'm a partner at Pillarstone. Pillarstone is a private equity investor. We invest in distressed assets. We are generalist, but we started heavily investing into the shipping world from 2017 with the dry market, and we manage now 1.5 billion of shipping assets. Our strategy is obviously related to, and we can talk about it afterwards, to the cycle of a shipping market, and we are owned and invest KKR money.
Thank you, Roberto. Andrian?
Hi, everybody. So I run a group at JP Morgan that focuses not just on shipping, but other transportation assets. We invest in aircraft. We have some land-based transportation, but in the shipping space, we primarily invest in the assets themselves. We're a bit different from a pure financial player. We do operate the assets, and our focus really has been on the longer duration, end user driven approach, and tend to put in longer term fixtures or charters in place and manage a diversified portfolio across many of the different verticals in shipping. So we have tankers, we have gas ships, we have dry cargo vessels and container ships, and some specialized vessels as well. And our fleet's about 100 ships, and we've been doing it since 2009.
Excellent. Simon, you want to do a few words, please?
Simon, I'm working in KLP, where I'm a portfolio manager in a long-short mandate, where we do primarily shipping, but also other energy assets. Much the same as Will, basically. Thank you.
Okay. Thank you, everyone. I think, let's start a bit broad here. And I think for the people listening, there's a lot of shipping competence on this panel. And, beyond the sort of scope of return, what is, it's a broad question, but why do you invest in shipping? What sort of creates the opportunity? What creates the excitement? Is it the mandate? Is it sort of the asymmetric risk reward? If you know, maybe Simon or Will, who sort of are, you know, heavily shipping focused, can share a bit about why you do invest in shipping.
I can start, Will, if it's okay.
Okay.
Well, yeah, I've been working with having a long-short mandate within shipping since 2007, and being a fundamental portfolio manager, it's a very good industry to have a long-short mandate, because within shipping you have all these segments which in their inherent, you know, the basic view of them is that they're all mean reversion, but within that mean reversion there are big volatility, and you can play them up against each other. So for having a long short mandate within shipping is good, and it works well for that strategy. Also, what's good when you relate it to energy is that even though it's a mean reversion industry, it's an industry that you can have super cycles, or where you can identify bottlenecks. So you can have, you know, go do heavy investment if you have a conviction idea. So this has been working for 15 years. So, and I still think it's fun. So that's why. So for a long short investment idea, it's good. For a long only, I'm not sure everybody's equally happy.
No, I'd echo what Simon says. I've also been doing it for a similar amount of time, since 2006, and it is yes, it's a very cyclical space which mean reverts. There are lots of moving parts. The demand and supply drivers are moving all of the time, so it's never we're never kind of just buying a stock and waiting for 5 years and coming back to see what happens. We're having to stay on top of everything that's moving all the time, and it is an exciting space to look at. And there's a lot which is now set to change over the coming years, as there always seems to be within shipping, which makes it, again, an exciting space to be. We have a lot of regulatory change coming. There's a lot of change in the shipyard space. And all of these kind of fundamental drivers we can try to model forwards, try to value, try to estimate what kind of returns we can make versus other sectors, other companies. It's it's a constantly evolving, interesting space to invest.
Andrian or Roberto, anything to add? Some color to why you love this space?
I would just add that, you know, it's a love-hate relationship, and I've been doing it since 1988, so a long time, and I'm dating myself. But I think, as was mentioned, it continues to surprise. It's a little unpredictable, and there are factors that are not necessarily driven by the underlying demand that shipping represents, which is global trade. But there's the sort of ancillary factors that get involved, and we saw, for example, in the 2000s, a lot of bank liquidity, you know, a big demand shock with China, of course, in that time frame. And I don't think anybody expected what's happened in the last 12 months with COVID. And I would say that going into COVID in March of 2020, the mood was dire and gloomy, and yet here we are experiencing one of the best shipping markets in the history of the shipping industry. So, you know, if you have a really good crystal ball and you can be a real good forward thinker, then, you know, and you can put your chips in the right place at the right time, then you can do well. But I think, you know, having a balanced approach, and what we do is just try to keep a portfolio that is not so much from an equity perspective, but from an asset perspective, is both short and long. So we can exit when we can take profits, and then, you know, double down if we see a good entry point from a price perspective. So it keeps you on your toes. Absolutely.
I can just add that we like it. It's an asset-based, you know, environment where obviously we can invest money in a certain way, and entering in the right point of a cycle, like we did with the dry in 2016-17 compared to today, where we start selling and exiting the segment. I think is, you know, it makes you realize how important it is to, you know, enter at the right point in the cycle, and then try to maximize your profit when it's consolidated. And private equity has to exit. We are not here forever to own the investment, so is a perfect space to invest.
Perfect. Thanks, everyone. Simon mentioned it. Will spoke a bit about, everyone, speaks about the volatility. I guess this question could maybe be to either Andrian or Roberto to start, but it also goes to Simon and Will. And creating asymmetric risk reward is often sort of a key in successful investing. And I guess from an asset base, that's easier maybe than in equities. In shipping, can you speak about how you create that? What are you looking for? What are you looking at? What do you shy away from in order to create that asymmetric risk reward?
I mean, I can make a few comments about that. I mean, I think you want to, at least from our perspective, focusing on assets that have the most liquidity is probably the safest bet. If you start getting into more specialized assets with limited liquidity or deployment prospects, then while they may look attractive at the beginning and you perhaps get a nice charter, if you don't have something to take it out at the end of that charter, which is unlikely to be for the useful life of the asset, then those are probably areas to avoid. And I just like to see sort of a, you have your field, if you will, and you're growing your crop, and there are certain crops that you harvest at certain times, and there are other crops that you just let grow and mature. But it's important to have that diversity. So I think in shipping, as opposed to perhaps in the equity markets, where a company is focused on one particular type of business, at least in my experience, having a diversified portfolio allows you to, like I said, invest more when something's weak and then take money off the table when you see something go up, which is the case now in dry cargo and container ships, and arguably weak in the tanker space. So diversification, I think, as an asset owner is critical.
I tend to agree. Diversification is very important for us. We like the asset class because it's very liquid. As Andy said, you can exit and you can get your money back. And the way how we look at it, because we enter in distress situation, we are able to invest our new money super senior. So we have first security on the vessel, and so for us it's very easy to return money back. At least the money that we invested with a minimum return, and then we can wait for the upside. So that type of investing into shipping, we find it very clever, because it's very difficult to lose money. If you obviously also enter in the right moment of the cycle, you can also make an extra return. So distress investing into shipping, we found it very interesting. In particularly when we started investing in Italy, almost all the companies were too small to survive and very, very distressed with a lot of debt. And we have been able to basically clean up balance sheets of the major Italian banks, buy all the distressed debt, and put in place a process of consolidating the market, which has now reached, let's say, a conclusion in this year, because we managed to integrate a lot of companies and create a lot of synergies as well from a cost perspective. So that is how we looked at this space.
Yeah, so I mean, Will, it's when you buy an asset, it's you could always measure it against scrap and scrap values, and that kind of gives the downside. How do you guys view this when you try to create these asymmetric forms when you take on bets? Or Simon, do you just do long short and take out the risk that way?
Oh, but it's not very different, because one thing that you experience in shipping is, of course, that you always have this floor of NAV support, but you see equities trading well below or well above those levels at any given times. We always, going, and we can also enter into distressed situations. So, for example, if you take the dry bulk restructuring happening in 2014-15, you had Eagle, Genco, which was best equity, but they were sitting in the bank, and then we can go informally into discussions with the bank if you want to take the company public again, and we did those situations. So we also look at, of course, we want to enter at the bottom of the cycle when you're investing in shipping equities. Another asymmetric thing that happens is that even shipping is globally, or it hasn't been very global priced. So you will find price differentials between Asian, European, and US regions, very similar type of companies. So there are a lot of, and we'll touch about that, we can do FFA against the public equities. So it's enough asymmetrical risk to create within a long short mandate, even though we're limited to public equity.
Yeah, no, I would agree. I guess one added element to the public equity space is it's quite small for the global market, so it has a limited covering. You often get quite large mispricings on both the kind of the downside and the upside, and one can try to isolate those via hedging out steel risk or via FFAs, intra-companies. We can try to take advantage of exactly the same asymmetric payoff opportunities.
Perfect, thank you. Speaking of things have rallied, and Andrian mentioned COVID-19. March 2020. At least I wasn't the one out there saying containers is going to be the best performing sector when the pandemic hit us, and I honestly don't think there were too many out there who made that call. It became more obvious as we went along. If we kind of rewind back and look what has happened up until now, there's been an enormous rally, obviously, in containers. Dry bulk has also experienced great. We'll leave tanker aside for now, just for the discussion, because and I think the audience will be curious. Like, the rally has been really hard. Does it have more legs? Where are we in the cycle on the segments that have rallied? I understand tanker is still not there, so let's leave that for now. But if you focus on containers and dry bulk and maybe some of the other segments that have rallied hard, where do you think we are? More legs to go, or time to get out?
Who wants to go first?
That's such a great question, right? That's the crux of everything, right? So looking ahead, and I mean, shipping has been historically quite cyclical, right? And we've had this exogenous shock that has upset the apple cart in a positive way. It seems like COVID is kind of not going away, and it's a little bit here to stay with Delta, et cetera. And I do know that when you look at the quarantine and logistics challenges in Asia, they're still alive and well. So as long as those continue to be the case, I think they've eased a little bit maybe in Europe and maybe not so much actually in the US. So you kind of got to watch sort of when everybody is vaccinated and people are moving around more, because ships sitting off the coast of China for 2 weeks, and I know there's been plenty of calculations about how much of the capacity globally these quarantines and logistic challenges has taken out, but it's anywhere from 10 to 15%, which is a pretty big impact. And so we have this perfect storm, but then at the same time, I do think the signs are that the US economy is weakening a little bit. And I always sort of sit back and say, is the world that dramatically different than it was in December of 2019? And yeah, it is, because we've been through COVID, but economically, is it that different? And certainly we weren't experiencing these kind of container rates. So these are all, I would say, artificial. And at some point they will work themselves through the system. And that's what you got to keep in mind when especially if you're buying for the long term. If you're trading and you think there's more upside, which there probably may be for the foreseeable future, then that's fine. But if you buy for the long term, buying at these high prices, in my view, is a mistake.
Simon or Will, what are your bets? Not specifically, but do you agree that we're sort of?
I think
almost...
when it comes to container, I would agree with Andy, but it's always like that when you're in uncharted territory. You've never seen this kind of effects in container before, and of course, when the efficiencies go out, I would tend to agree that I would think it would be a large downside from what we see now. For dry LNG, I'm not so certain. I'm not certain where we are in the commodity cycle. We still have a lot of legs. And when you look at what capacity is available at the yards, where you see where new building prices are in a longer perspective, I'm not sure that we're there yet to say that this is over and this is the place to exit.
Well,
no, I'd agree. I would agree very much on the dry bulk side. Yeah, going back to the shipyard capacity is the kind of that driving element. Having reduced by about more than 40% over the last decade, there simply isn't enough global shipyard capacity currently at today's prices to replace the fleet fast enough, especially when we look at new regulations coming in the future. You know, we don't really have the designs or the yards capable of building such ships that we don't even know what those ships are yet. The kind of cost inflation we're seeing at the yards, or at least what I estimate, is growing incredibly fast this year, 20-25% from steel, labor. Earlier in the year, the weaker US dollar, that really resets the entire asset curve significantly higher for the commodity-based shipping sectors, where that replacement cost of the ship is a real driving factor to the longer-term rates. So I think on the dry bulk side, especially given the very low order book supply situation going forwards, it still looks relatively cheap in the long term. And on the container space, yes, the liners have done very well. Probably one thing which will change going forwards, even when the market starts to revert to how we were pre-COVID, we probably will start running higher inventories globally than we had before. I think it's this kind of situation has really highlighted the just-in-time delivery situation. There's far too much risk. It may make sense from a financial point of view, but it doesn't from a risk point of view, that you can't actually deliver the goods that you're manufacturing. So we probably start seeing more of a just-in-case type inventory system, which should lead to probably higher demand further into the future.
Okay, interesting.
Just as a couple of observations, right? So it wasn't so long ago that we were in a conference like this, maybe around 14 and 15, and everybody piled in 2009 when the market was heading south, and we had pretty much a different situation, right? A huge overhang of capacity, not capacity, but orders that ultimately got delivered throughout the course of the 2010 to, let's say, 2020 period. And that was a really dismal period, right? And a lot of private equity went in, and we went in, and I would say that, you know, the returns were not great. And now we find ourselves in this sort of odd position where, as is mentioned, shipyard capacity is contracted, regulations are there, slowdown in the fleet probably is going to be one solution coming in 23, and it all seems really good, and yet shipping does have this tendency to surprise. And the one thing that worries me is that when an industry that is not that big generates a lot of excess cash flow over and above what it historically generates on an average basis, where does that money go? I mean, the right thing to do would be for the container liners to branch out and, you know, buy air freight companies or something else. But if it all then piles back into buying new ships, then you get a capacity issue, notwithstanding that yard capacity is limited. But I do think, even though in China there is some restrictions in how, because labor costs have gone up, the Chinese, and I think they would still meet the challenge of sprouting new shipyards, as far as I can tell. So all this cash being made now is the thing that worries me the most in some respects.
Thank you. Then switch to you know, opportunities ahead. I shouldn't say tanker is the only segment that hasn't rallied, because there's probably a few that I'm not aware of right now, but tanker seems to be the obvious one right now, you know, looking at containers, looking at tankers. Maybe start with you, Roberto. You mentioned it earlier today. Is tankers so the next one to rally?
Obviously difficult to say exactly, because COVID has broken a little bit the schemes, and we don't know what the post-COVID situation will be. We certainly think, as I mentioned before, that if you want to invest in shipping, you need to be cyclical. And I think if the dry has rallied so much, for us, makes sense to get out, cash in some of the profits, and with the rest, talking about where the money goes, we think is a good opportunity now to invest in tankers. 70% of our fleet is now made up by tanker, MR and LR mainly, and so we are waiting obviously for this market to pick up. So our hope and also our view is that there will be a rebound in this segment. Also, last point to mention, the few distress opportunity that we see and where we can be active in are in the tanker segment at the moment, because obviously, especially small companies or over leveraged companies are struggling a lot. So we are working closely with 2-3 owners to try to rescue, the situation. So that is my point of view.
Simon, on the equity side, you agree in that?
Yeah, we can start looking at tankers now, yeah. But I'm not overly enthusiastic. Yeah, the reason for that is that there's been too little scrapping the last year. So it's a big scrapping overhang, and all that scrap tonnage is trading in a big embargo market. And the money is too good in that embargo market. So before that happens, of course, it's a big normalization trade. So if you believe in normalization next year, 4 million barrels extra on the water, of course, then tankers is the place to be. But we're not sure about that yet. And given that we're not sure about that, the risk reward it's balanced, I would say. I would be much more enthusiastic if I saw more demolitions of the fleet. There's 30 wheels going to be delivered the first quarter alone. It's a big number. So then you really need them all to pick up. And I would also like to see scrapping and maybe a reduction in the embargo market. So if Iran were to return, I think it would be good for tankers.
Well, scrapping is interesting. Will, do you share any views on the scrapping side?
We are fairly similar view to Simon in that we've stayed away really from tankers to invest so far, but beginning to get more interested now. But equally is we're kind of getting to an interesting point. But the physical market has been far too optimistic, waiting for this recovery to happen, which isn't yet happening. And like Simon has said, very little scrapping. But the supply outlook in the tanker space is very positive. The age of the fleet, the scrapping pool that needs to be removed is vast and outweighs the order book. So if those ships are actually removed as they should be, rather than trading in this embargo market, then it begins to look very interesting. But 3-4 months ago, much of that was already priced into equities, that is. They have retraced a bit as maybe the equity markets become a little more rational, but at the same time, FFAs for next year are incredibly cheap. Maybe that is the way to play the trade.
Thank you. Just to switch a bit, ESG, the topic of any investor conversations and funds, capital raising, etc. ESG, is it a threat or is it an opportunity for shipping and investing in shipping?
I can jump in. I would say it's probably just a reality. I don't know if you can escape it. It's there and it has to be contended with. I think there are limitations in terms of what ships can and can't do on the E side of the ESG, but I would say the goal of a ship owner is probably to try to be best in class. And the point that Will mentioned in terms of new regulations coming, they are coming. And I think probably one of the reasons we're in a positive market too is that people haven't been investing in new builds so much, although that's changed a little bit in the last few months. But up until COVID, there was big uncertainty around what the right asset to buy if you're buying for 20, 25 years versus if you're trading equities. I think that's a much shorter time frame, and you can be a lot more nimble. So I think, yeah, look, the world's more transparent. You have to incorporate ESG, but at the same time, I'd also say the shipping industry, in my opinion, doesn't do such a great job of articulating all the successes that it has, or all the positive profile that it has. And very simply, you look at the carbon emissions from, let's say, a 10,000 TEU container ship, which in aggregate it looks like a pretty big number. But then if you say, all right, what's the same emissions from 10,000 lorries moving that same cargo around the same distance on land? It's multiples of what a ship does. So better communication and education is needed, I think, in just articulating how efficient shipping is. And if we can continuously knock down that emission level, then that's pretty good. And then we'll see what happens with future fuels.
Roberto, any comments?
Yeah, no, thank you. Obviously, ESG is for us for all the portfolio company that we have in every business is a huge threat and opportunity. I think in the shipping business compared to other investment we have, we see that there are much more opportunities, maybe because shipping is a little bit behind compared to other industry in terms of regulation kicking in, and you can learn from other businesses. We find fascinating the fact that we can set up some parallel business to the shipping that can deal with the change of regulation and can leverage on the change of regulation and ultimately do well and do profits from that. ETS trading, advisory for companies. We find ourselves obviously in big threats when we need to understand or to decide which ship to keep, which ship to buy, which technology will be the technology, and if you spend 40 million for a new MR now, if it's a good investment or not, it is very difficult for us to decide this. But for sure, parallel to the industry of shipping, there are a lot of opportunities that for an investor that does also other type of investment can consider.
So, Will, should the company, should they buy into new assets, which we're not really sure what should look like in the future, or should they return capital? Buying back shares, dividends?
I guess it very much depends on what the company is, which sector it's in. Like was mentioned earlier, the shipping is already incredibly efficient. Making it more efficient to begin with will be relatively simple, but getting it down, cutting the overall greenhouse gas emissions by 50% over the next 30 years that needs completely new types of propulsion. I think in investing now in modern secondhand tonnage or relatively modern, middle-aged secondhand tonnage is probably fine, which can be retrofitted. I think making huge leaps into unknown propulsion technologies is very risky. Investing in assets which are adaptable and flexible in the future, I guess, is the way to go. And we are seeing a number of companies beginning to invest in dual fuel, LNG ready, ammonia ready, etc. Things which could be retrofitted at reduced cost in the future, but still, can't use these technologies which don't exist yet. But no, I mean, this is a big opportunity for shipping. It is, backing the right horse, cleaning up the image for the investment space. I guess many lay people would consider shipping to be dirty. They see, plumes of dark smoke coming out of a ship, but it is incredibly, it's 10 times more efficient than lorries, hundreds of times more efficient than air to transport similar amounts of cargo. And then on the ESG, we don't even move into things like corporate governance, which is improving all the time in shipping, but certainly as an equity investor, backing the right management team of a corporation is very important. And the corporate governance of those companies is a very important thing to consider when making those investments.
Thanks, Will. Simon, where do you stand on this issue?
No, in KLP we're pretty firm on it. One thing is the new regulation that's coming if we want it or not, and I think it will be good for shipping. One topic that is shameful plate for shipping is of course scrapping, which has been there for as long as we can remember. It's been done very little, but now at least for listed companies in Europe and in the US, maybe also to a limited extent, just starting to get more focus on it. So if I want to touch upon the ESG subject, this is close to my heart. It's how we demolish the ship and how the industry puts up with that standard.
Interesting. Simon, you mentioned the normalization trade. If I put it out there, the biggest, maybe one of the biggest risks is, COVID sort of easing and world back to normality. But congestions has also, been a big issue due to COVID. So as the world normalizes, the world gets better, it gets more efficient. We want the normalization, but that takes away congestion. How should we think about that? Investing in future. Can we have both?
Well, the first thing how you should think about that is that you want the normalization. That's how we should think about that, and then we have to think about the investment later. But no, of course, for a normalization means that trades that have been most hurt by the situation we're in will of course flourish, and that will of course be oil demand, jet fuel, and tankers, and containers, which has flourished on inefficiencies, will of course suffer. If you look at dry bulk, there's also inefficiencies, especially on some sizes. But if you look at the smaller sizes, there's not the big number is not that big. It's still 3-4%. It's not 10 for the smaller sizes, as some said. But I think a normalization trade is, of course, to short everything in container and only buy tankers. If that happens overnight, we'll make a lot of money. If you're not making it on the long side, we'll for sure make it on the short side. So that's the normalization trade, of course. Yeah. If it happens, I'm not sure. I believe it does. I believe we're going back to normal next year, but that's my view.
Andrian, what does it mean to your asset portfolio?
Yeah, we try to chart sort of the middle path as much as possible and not get too exuberant in this market. Again, we're buying assets, so we have to take a longer view. And as I mentioned, right now, buying dry and buying containers it's heady business, and that could potentially hurt you. But tankers, I think, look okay. And although prices, it was mentioned that new MRs are being quoted at 40 million now, which for ships that you could buy for 30 years ago, that's a pretty big jump in a new build price. And I think one of the biggest challenges is probably going to be for seasoned ship owners to get used. If this is a price reset, if shipyard capacity does not expand, and and we have to contend with higher prices, and there's a mentality. And if you look at historical average prices, they've tended to revert to a pretty consistent mean over 30 years, frankly, especially on a dollar inflation adjusted basis. So I think you could get caught out of missed opportunities if this is in fact the step up in terms of long-term yard costs, which the market will have to adjust to. So new builds become an interesting proposition. But anyway, we just try to balance it out and sell the assets that are hot, which we're doing now.
Okay, Will, anything to add, Roberto? To the can we have both? We have to go short something.
Will, I think it's more for you.
No, I mean, I guess that normalization, the key element of it is the timing. When does it happen? I guess if you'd have asked me at the beginning of this year, I thought we'd be more normalized by now. I thought we'd be flying around a little bit more over the summer. If you ask me now, I think maybe maybe it's next summer. You know, it's taking a lot longer than we thought to get back to normal. Maybe from Q2, Q3, we start to see international travel picking up again. Until then, this kind of congestion and disruption in efficiency can probably keep these markets very unusually priced, let's say.
I think the point that you touch of timing, I think, is critical, especially for an investor that has to invest for a period of time. So critical, the timing of recovery. Let's hope it's soon.
Okay. Well, that's our time, gentlemen. Simon, Andrian, Will, and Roberto, thanks so much for your time. Thanks for your insight. I think we could have gone on for hours. There are big topics at hand that we're discussing, but we caught up on a few of them. So appreciate all of your insight. Appreciate your time. And Nicholas, I'll give the word back to you.
Thank you. All I want to add is tremendous thanks. As expected, that was an amazing discussion. Thank you very, very much. At the end of the day, you know, we talk about investing in shipping. You are the investors. So thank you very much for this great discussion.
Yep.
Thank you.
Bye-bye.